Hello everyone. Today we look at what volatility means. We will talk about its limitations and possibilities. By the end of the video, you'll see that while volatility shows quite well the riskiness of a particular investment, it's not equal to the risk itself. If you ask experts about how to demonstrate volatility, then you will get answers that it is nothing more than an indicator of risk and the direction and extent of the exchange rate shift. Well, be happy with that. To interpret this, let's first look at what the risk is. Although on the subject of volatility, it would be obvious to say that the risk is exchange rate change, but it is not. If you look at the two yield curves, or rather the yield line here, you can see that neither is riskier than the other, as in both cases you will know exactly how much money you have and how much you will have. Risk is nothing more than the possibility that you as an investor will suffer a loss. There are usually two reasons for you to suffer a loss. The first is that you get scared of a temporary price drop and sell out of panic at a lower price than you bought. The second is that the company whose shares you are holding has undergone some unwanted change that has either made their product unnecessary or made it impossible to operate. As a result, its exchange rate also decreased significantly, or the whole thing disappeared. While there is no guarantee that a little weight will help you either avoid a loss or make a profit, it is definitely a good idea when it comes to the first case. You may be wondering why volatility is a good way to measure risk. The price of a given stock includes a lot. Everything that is available to investors at that moment. It shows not only the information but also its lack. When the volatility of a given stock is high, it shows a great deal of uncertainty on the part of investors. Therefore, it also means a high risk. Let's see how you can measure exchange rate movement. One way to measure is to compare the exchange rate to itself. The standard deviation is suitable for this, which shows the deviation from the average level of the exchange rate. In addition, the square of the standard deviation, called the variance, is also used. Another way to measure is to compare it to the market. Then you look at how much and in what direction the value of your investment will change if the market moves 1%. For stocks, beta shows it, and for bonds, duration does you a good service. As I mentioned at the beginning of the video, there are limits to volatility. Let's see what mistakes you can run into if you want to measure risk just by using only volatility. The first mistake is to realize your loss out of sheer fear. There is typically a basic instinct in people that is commonly referred to as the fear of missing out. This turns on when exchange rates rise dynamically, as many investors fear of missing out of seemingly easily achievable earnings. Because of this, many of them are getting in on top of the exchange rate rise, even if they are more experienced. When the exchange rate falls for any reason, they are frightened and in fear of further loss, prefer to sell this investment. And that's exactly why they're going to lose. If they had waited for the bounce without looking at it every day, they would have stayed with their money. In the case of short-term investments, volatility is definitely an expression of risk. After all, even intraday shifts can have a serious effect on your return. In the long run, just paying attention to this is the point that it encourages you to have losses when sold at a low point. The other mistake it hides is that you can easily focus too much on the price of that particular stock. It is a fact that it is easier for a stock with higher volatility to fall deeper, as well as people tend to sell at the low point for fear of losing. As a result, more investors may have higher losses with highly volatile stocks. Apart from this, a distinction must still be made between the share price and the share value. For example, take a company that is completely stable anyway. There is a market demand for its product. The shares of this company should be worth, say, 10,000 forints per stock. If the exchange rate suddenly drops to 2,000 forints, it is far from true that your risk is higher. After all, the company didn't shrink for a fifth at this point. Their machines and tools have remained, or they haven't lost their market. Since only its exchange rate has fallen, it continues to operate normally. If you buy a stock at this point, you get the same, only at a significant discount. This will make you risk even less money. The third mistake is to try at all costs to invest your money in assets that are said to be safe and have low exchange rate movements. Yet volatility is not always bad. Let's return to the definition of risk for the duration of a sentence. This is nothing more than the probability that the investor will suffer a loss. If you look at the picture, you can see that dark blue has a much higher volatility than light blue. An investment marked in light blue is more guaranteed to generate a loss for you, even with lower volatility. The fourth thing to look out for is volatility is calculated to a given period. It therefore necessarily looks backwards. If you've already invested in anything other than a bank deposit, you may have heard that past returns are no guarantee for the future. To be able to calculate volatility, you need already fixed and known exchange rates. This in turn shows what effects the company has had in the past. However, as an investor you will be much less curious about that than what to expect in the future. If anything has happened in the life of the company that affects its life, through this its level of risk, then it will indeed appear in the exchange rate but only later. In closing, let's look at how to handle assets with higher volatility to get results that work for you as well. From what you have seen so far, although volatility is not equal to risk, it still expresses it quite well. That's why in order to get good results, you need to do the same as with high-risk assets. So diversify, share the risk. This can happen between different instruments or between periods for a particular instrument. For different devices, higher performance in one direction compensates for lower performance in the other direction. The same is true when you invest for the long term. Then the results of one period balance the setbacks of other periods. You can even use them in combination to have an investment with the right level of risk for you, but still with a good return possibility. Subscribe to the channel to be the first to receive news about updates and like the video to see if you liked it.